I've taught people how to become their own banker for nearly 5 decades. In this educational episode, I'm going to address the question, is the banking concept explained in my various books legitimate? Absolutely. Get ready. I'll explain why. So I'm Doug Andrew. I've been a financial strategist and a retirement planning specialist now for nearly 5 decades, helping people optimize assets, minimize taxes, and empower what I call their authentic wealth. And I've been very blessed in the 48 and a half years as of the recording of this episode to have authored 12 books so far. These are some of the 12. And many of them have become not only bestsellers, but my third book, called The Last Chance Millionaire, actually became a New York Times and Wall Street Journal #1 bestseller the second week it was released in 2007. And even though in my previous books, and ever since the mid-1970s, I've been teaching how money works and how you can actually become your own banker, in that New York Times bestselling book, the 7th chapter actually was titled, Learn How to Become Your Own Banker. So I'm not claiming to be the original thought leader of this concept. In fact, it's as old as the Bible. If you really understand the parable of the talents in Matthew chapter 25 in the New Testament, or the parable of the pounds in Luke 19, it's been around for centuries. But I've been teaching this since the mid-1970s, and I've been teaching how to become your own bank, so to speak. Now I call it the laser bank concept. Ever since, of course, these books were released. Now, I need to make sure you understand that I am not affiliated with Pamela Yellen, Bank on Yourself. She has asked me to make it absolutely clear in my episodes that I'm not affiliated with Bank on Yourself. I think she came out with her first edition of that in 2009, if I'm not mistaken. I know that Nelson Nash, who is the originator of the infinite banking concept, came out with a book in 2008, I believe, How to Become Your Own Banker or Becoming Your Own Banker. So there's a lot of people that use similar terminology, and I have been using this ever since the mid-1970s. But all of these concepts sort of talk about how money works. Now, I do not endorse the infinite banking concept or bank on yourself. And I want you to know that, do they work? Yeah, they can work. The way that I teach in my books is how to be able to apply the concepts of banks and credit unions where you can actually become your own bank, so to speak. I call it a family bank, but many times I call it a laser bank. So in this episode, let me give you a few examples of what I've been talking about now for nearly 5 decades. So I've been talking about how money works, why banks and credit unions pay interest, for example, and they deem interest as their friend, not their foe. In other words, they borrow OPM, other people's money, and they pay interest, and they pay 1, 2, 3, 4, 5%. For a long time, recently, they've been paying a measly 1% interest. So I simplify that and say every $1 million that banks and credit unions pay 1% interest on, they pay $10,000 a year in interest. Now, are they just a benevolent institution paying interest? Do they just keep your money in their vault and somehow they can afford to do that? No. What are they doing with that money they're borrowing from us that deposit money into their institution? They're putting it to work. Now, I prove that during critical times like 2008, when 400 banks actually went under, 900 more banks were on the brink. They were on the watch list of going under. And so the federal government of the United States asked the 5 major banks in America in 2008 to disclose where they had their Tier 1 assets for liquidity and safety. And guess where they had 30 to 40% of their Tier 1 assets for liquidity and safety? In insurance companies, okay? In other words, banks and credit unions were borrowing our money at 1%. Every million, they paid $10,000 a year in interest to borrow our money. They turned around and put 30 to 40% of their Tier 1 assets into the multi-trillion-dollar insurance industry, because that's the backbone of America. It's the backbone of the world. And they're some of the best money managers in the world. And they were just fine with the general account portfolio rate of 5%, let's say from 2000 to 2010 during the Great Recession. So if you do the math, they were paying $10,000 a year in interest, but they were making $50,000 in interest by taking your money and putting it into insurance companies and increasing actually the liquidity and the safety, because most of these insurance companies are rated AA and AAA, where a lot of these banks are only rated BBB. BBB is like 6 notches down. So banks borrow your money, increase the safety, the liquidity, and the rate of return by 5 times. That's a 500% return. If they're borrowing and paying $10,000, but they're making $50,000, how much more is $50,000 than $10,000? It's 500% more. It's 5 times. Would you hire an employee for $10,000 that made you an extra $50,000? Would you buy a widget machine for $10,000 that made you an extra $50,000? That's called a 500% return on employment cost or equipment cost. That's the banking concept. And so that's what banks do. And so for years, I've been teaching how I have been doing this my entire adult life. And this is why many times, even though if I have the money, and my savvy real estate investors who have the money, they choose not to pay cash for their house or their real estate. They have the money, but they go in and they borrow money because they can borrow money cheaper. They can borrow money at 4.5% tax deductible interest in their business or on their real estate properties, because in a 33% tax bracket, borrowing at 4.5% on $1 million loan, that's $45,000 a year, but they get to write that off, which offsets $45,000 of taxable income. In a 33% tax bracket, they saved $15,000 in tax. So the net cost borrowing at 4.5% tax deductible interest is only 3% or $30,000. And they, like me, I can earn 9% in my laser funds, my max funded index universal life insurance policies. How much more is 9 than 3? Don't say 6. It's 300% more. There have been times where I have borrowed money at 3% tax deductible interest in a 33% bracket. That's a net cost of 2. And I have earned 10%. I've earned 11 and netted 10 on my indexed universal life. How much more is 10 than 2? It's 5 times. It's 500%. At the same time, banks were borrowing money at 1%. They were putting it into insurance companies and earning 5. They were making 500%. I was making 500%. Now, the reason why I do this is because with indexed universal life, this banking concept, which is legitimate, this is what people have been doing for centuries. This is what makes the world go round. You borrow money at a lower rate than you're earning. That's called arbitrage. You're earning a spread. Yeah, you could borrow money at 4% and earn 6 and have a 2% spread and come out ahead. But golly, if you can borrow money at 4 and earn 8 or 12, you come out way ahead. That's why my preferred instrument to use a banking concept is max funded indexed universal life. So let me give you an example here. I have a client who's a very sophisticated real estate investor. Now, he doesn't like to be a landlord. He likes to buy big multi-million-dollar apartment complexes and fix them up and then flip them. So in 2017, he called me and said, hey, Doug, I need $1 million out of my indexed universal life insurance policy. Well, he has done this many times. He said, would you please email me that form? Well, he knows it's a one-page form. So I emailed him the form, and sure enough, he puts his name and his policy number, and that's like an account number, to his indexed universal life insurance policy. And the form said, how much do you want to withdraw or borrow? And he says, I want to borrow $1 million. Now, he actually had the option to withdraw $1 million if he checked that box, but he checked the box borrow. Why? Because if he borrows, he can borrow $1 million out of his policy, and he can do it with a zero wash loan. He can borrow from the insurance company because they will loan him $1 million because they have his money in their company, in his policy, as collateral. So if you had $1 million in a bank and you went in, you could withdraw the $1 million, or you could borrow from the bank because they have your money as collateral, okay? But with the insurance company, he could borrow his $1 million and they would charge him 2%. And then they would credit the collateral, the $1 million that they're keeping of his money, 2%. That's called a zero wash loan. It doesn't cost him anything. But why does he do that? Because it's tax free. If he did it the dumb way, he may trigger unnecessary tax if he takes out more than what he has in basis in the policy. That's another topic. But see, the smart way is to borrow out the money because that's not deemed earned passive or portfolio income. It's tax-free. But he is super savvy, so he does what I do. He borrowed at a higher rate. That's called an index loan. So in 2017, he borrowed $1 million out of his policy. He checked borrow, and at the index rate that year, it was 5%. And sometimes people go, why would he borrow his own money at 5% when he could borrow it at 2% or just withdraw it and it doesn't cost him anything? Because he understands the true cost, the opportunity cost if he did it any other way. So he borrowed at 5%. Why? Because they won't just credit him the same rate that he's borrowing at. They will credit that $1 million plus the rest of the cash value he had. But on the $1 million that was collateralizing the loan, the insurance company credits him the indexed rate. Do you know what they credited him in 2017? 25%. That year he capped out at 25%. Okay. Now 25% is $250,000. So they credited $250,000 tax-free. So he had $1,250,000 at the end of the year because he made $250,000 in tax-free interest. And they deducted the $50,000 loan from the $250,000. So he netted $200,000. He had $1,200,000. And so he netted 20% or $200,000 tax-free on the $1 million that he left in the company as collateral for the loan. And he took that $1 million loan and he flipped a piece of property that he borrowed the $1 million for an earnest money. It was a multi-million-dollar property. He flipped it and he made about $3 million. So wait a minute here. He made $3 million in 1 year by tying up this piece of property, fixing it up and flipping it. He made $3 million. But he did that while he was still making 25% on the $1 million that he technically did not withdraw out of his IUL policy. He left it there as collateral. He earned $250,000 minus the 5% loan. He netted 20%. He made $200,000 tax-free on his money while he was using his money in his business. Now think about it. That's what savvy people do. He does that with his indexed universal life because the only way he could do that with any other type of an instrument, another type of insurance like whole life insurance, would be to put it at risk in a variable whole life policy. And he didn't want to risk it if the market went down. So he used indexed universal life, where he has been able to earn 25%. And even in 2020 to 2021, many people locked in gains of 61.33% on their IUL policies. How would you like to borrow at 5% and earn 61%? You're netting 56.33% when you use the banking concept employing indexed universal life. So that is what I've been teaching people to do for more than 5 decades, and I'm not the first one to do it. It's been around for centuries. If you want to learn more about this concept, I would recommend that you read and study my most recent best-selling book that's been flying off of our warehouse shelf. So we send out about 150 to 250 of these a week. Don't miss out. You don't have to pay $20 on Amazon. I will gift you a free copy. You simply claim your free copy of this 300-page book by going to laserfund, laserfund.com, and you contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost, and I will pay for the book. I'll fire out a hard copy to you. It's actually 2 books in one. This side is 200 pages, 14 chapters, all the charts and graphs if you're a left brain learner. If you're a right brain learner, you flip it over and read this one. This is about 100 pages, 12 chapters with 62 actual stories of how clients have used maximum funded IUL. When it's structured correctly and funded properly, it is called a laser fund, okay? And they use it for these kinds of concepts and to create tax-free income that will help you not outlive your money. If you want to use your whole brain, your right brain and your left brain, I would read both of these, okay? But while you're in there, if you like to listen and learn or watch and learn, there's audio, there's video, and check out our educational webinars that we teach on a regular basis. They're free. You can even put your name in a slot to have a free consultation and analysis with one of the top specialists in America that understands how to apply these concepts in your particular set of circumstances, and they will not charge you for their time to do that. So this is about you and your brighter future. I want you to understand that, yes, this banking concept that I've been teaching for decades is absolutely legitimate, and you ought to check it out, and you can learn about it by studying, watching, listening, and you'll be blown away when you understand how you can do what banks and credit unions do and have interest work for you instead of against you.